Hey, what's going on, Cashflow hackers? It's Chris, and this video is going to be a clip from a live video that I did talking about positive arbitrage, infinite banking, and how infinite banking is not about positive arbitrage at all. I know that kind of comes as a surprise to a lot of people. In fact, it is one of the reasons that I say that you cannot utilize IULs for infinite banking, because the conversation about positive arbitrage and IULs is way overblown and not true at all. But facts are, it illustrates like that until AG 49B comes out. And at the end of the day, what we're going to be talking about here is going through the positive arbitrage conversation and talking about how arbitrage potentially works and where it actually doesn't work, so you have a full understanding and can make an educated decision about if infinite banking is right for you or not. So if you haven't already, make sure you click the bell, subscribe, that way you're notified every time I launch a new video. Enjoy the video. Take care. The question is about positive arbitrage or spread, right? We'll just write this out. So the idea is, Jonathan is saying, if I put in $100,000, if I had $100,000 of cash value, can I take a $100,000 loan and earn, pay 5%, we'll say pay 5% and earn 5.5%. Let's say it's a 5.5% dividend. So the idea is, can I borrow all this, pay 5% and earn 5.5%? The answer is no, you cannot. Here's the deal. Thank you for asking that question, by the way, because that's one of my, so I'm trying to think of how to put this. This is the interesting part about being live. I got to be really, really careful about how I phrase this stuff because I don't want to tick some people off. But I'm just going to speak my truth here. How about that? The bottom line is, this is where people are getting misled when it comes to infinite banking online right now. Here's the deal. There's a difference. If you have a 5% loan rate, let's just go here. I'm gonna do this. If you have a loan rate at 5%, and then you have a dividend rate for whatever company at 5, and let's just call it 5.75%. This is a gross dividend rate, okay? Meaning everybody's used to gross income and net income, right? And so what this is a gross rate, not a net rate. And what is the gross income is like what you make before taxes, and the net income is what you make after taxes, right? And so after taxes, Social Security, and all these different things. So the gross rate is the 5.75, but then there's a net rate that is minus all that charges, cost of insurance, expenses, and all that stuff. And that's what ends up getting paid out. And that net rate is typically, I'm going to tell you, 4% at the end of the day. So here's the deal. Infinite banking is not about positive arbitrage, being able to say, all right, I'm going to take this 100,000 and I'm going to borrow. First of all, you can't borrow 100% of it. You could probably borrow 90% of it, and you could use a third-party line of credit, and you could have access to a higher percentage than the 90% in a lot of situations. However, at this point in time, the line of credit is going to be a higher rate typically than the insurance company is going to charge you. And so, if we were talking a year ago when you could get a line of credit for 2.5%, that made sense. But now it doesn't. But once again, that's one of the reasons, the power of infinite banking is that we're talking about, if let's say you're 35 years old right now. I'm just going to go over here. Let's say you're 35 years old, right? Let's say you're doing this until you're 90, right? So what is this? That's 55 years, right? You have 55 years that you're planning out here. So by implementing infinite banking, I did a video the other day talking about how infinite banking can help you in every phase of your life, right? And so when we look at infinite banking in every phase of your life, what does that look like? You got all right, 18 to 26 years old, right? What is this? You're trying to build your financial foundation and understanding. And then from 26 to 35, you're trying to launch. You're trying to launch your life and trying to start to get some momentum and success. And so then 36 to 45, you're actually trying to really build that momentum and compound it. Momentum, I can't spell. And then you know, from 46 to 55, you're trying to maximize because it's your biggest income earning years, and your kids are out of the house. And then from 56 to 65, you're preparing, right? You're pivoting, you're prepping for retirement. Prepping, you know, I'll just say that just for the sake of simplicity. You're preparing for retirement. And, you know, this is kind of the traditional way of doing things. Now, I would argue if you follow what we're talking about, you know, rather than having to go down this path, if you implement what we're talking about with infinite banking and you do this and you kind of repeat the process. In my book, Cashflow Hacking, I have a whole section in there, 7 steps to financial freedom in 10 to 15 years. And you could literally just implement these 3 things in those 7 steps. I'm not going to get into them in this video, but you can go down in the link in the description below and get a free copy of my book, cashflowhackingbook.com if you want to go get it. But it's all there, and I talk about, like, if you implement and execute on this, you can reach financial freedom faster. I just also want to implement and kind of like inject like how the impact this can make if you are following kind of like this traditional way of thinking, right? Now, here's the other thing though. We're talking about a 55-year period, right? So when we talk about like 66 years old plus all the way to, you know, death, what are we talking about? We're talking about the fact that you have these plans and you have these needs at every phase of life, and interest rates are going to change. The economy is going to change. Economic uncertainty is going to change. We're going to go through, if we're talking about 55 years, you're going to probably have 10 boom bust cycles, right? So you're going to have 10 boom bust cycles-ish, maybe 8. Okay, I'll correct myself. 8. I'm doing math in my head. So you'll probably have 8 boom bust cycles. And so the question is, like, what does that look like to you? And unfortunately, like, I'm hearing a lot of stuff right now, and it's funny. I have this one video, it's a short on YouTube, and it's all about don't put money in bonds or CDs, utilize whole life insurance instead. And there's a reason, because whole life insurance will get you bond and CD-like returns, but it'll give you the liquidity effectively of a savings account, and you can leverage it and do all these different things, all the things we talk about, right? A lot of people are now giving me a hard time because I filmed that video, by the way, like, I don't know, 14 months ago, right? Back when CDs and bonds were paying garbage, right? Now CDs are paying 5.5%, bonds are paying 5.5%, 6% in some cases. Sometimes if you get I bonds, they could pay even more, right? And so, like, people are looking at this, and now all of a sudden out of nowhere, I'm getting all these negative comments from people. Even though when I filmed the video, it was absolutely relative, right? Like it was true, and I didn't get anybody piping up and saying anything negative. But now, because people can go out and get, you know, CDs, bonds, and have good, you know, better results there, and they will beat whole life right now, and they will. I'm not arguing that. I'm never going to try to convince somebody, look at the math, and it is what it is. Now, you lose some liquidity, right? So that's a downside of these. But the bigger problem with this is that you don't want to make short-term decisions to solve long-term problems. And if we know that we're going to be in this game for the next 55 years, the question is, what do you want your life to look like? And when you start with the end in mind, and we don't think about, like, what is the rate of return that we're getting just this year, but we think about, what do we need? These products, I don't care. I could list out all the different financial products, stocks, bonds, mutual funds, life insurance, annuities, CDs, like all these different things. We could do that. And the question becomes, what do I want my life to look like? Not what are the returns I can get this year, but what are the products that I'm going to put my money into? What are the features and attributes of those products that I'm putting my money into? And how is that going to help me get closer to my goals on a guaranteed basis for the rest of my life? How is it going to help me actualize the results in my life? We need to start thinking less about returns and more about results, and what we have to do in our lives, how we have to leverage money as a tool, how we have to personally grow, and what we need to do to be able to grow into becoming that. And when we start thinking long-term, this 55-year period, we start thinking intergenerationally, now the whole game changes, right? Like everything changes when that happens. And so when it comes to this, kind of coming back to your question, sorry, I went on a tangent there, but like, this is not about positive arbitrage. You are going to have negative positive arbitrage, especially out of the gate in a policy. Now, I did another video. I'm gonna do this. I'll explain it right here. Okay. So we go 1979. Okay, and then we have like 2008, and we have 2020. This is obviously not to scale, folks, so bear with me, okay? So 1979 interest rates. I'm going to do blue is going to be interest rates, okay? So I got to thicken that up a little bit here. Boom. Okay, so blue is going to be interest rates. We got 6% interest rates was in 1979, and then 1980 interest rates went up to 19%. And when I say interest rates, I'm talking federal funds rate. And so from there, the market like took a hit, and then from 80 to 2008, and I'm drawing a straight line. It wasn't very straight. It was up and down, up and down, up and down all over the place. But at the end of the day, you get the point, right? We had this declining interest rate environment. Now, on the flip side, we had whole life dividend rates. The green I'm going to put is whole life dividend rates. Right now, in 1970, we had whole life dividend rates at whole life dividend rates were, let's just call them 4% or 4.5%. Right? They were low. Every company is a little different, 4.5 to 5.5%. But they would go up, but they always lagged, right? And then eventually they crossed over. And so there was this crossover point, and then they lagged, right? And they went down, and they got all the way down to like, well, they lagged a little longer. Once again, not to scale. And then they got all the way down to, let's just call it 5.5%, right? And then they've been flat. Now, all the while, federal funds rate stayed low at 0 to whatever, and then it started going back up. What's happened now is the dividend rates are, boom, they've crossed over, and now they're going up again. So what's happened is, this is my big problem. A lot of infinite banking people don't understand this, and they have the best of intentions, but they don't really understand how it works. Like this space right here, we lived in an environment where there was positive arbitrage potential once the policy matured, right? Because this is what it is. But now what's happening is we're on the flip side. Dividends always chase interest rates. That is an important thing to understand. Dividends always chase interest rates. So back in 1979, if I were to draw this scale out all the way back, this would be over here, and the rates were higher, and it was negative, right? Like these rates are going to chase the dividend rates are going to chase the interest rates up, and then they crossed over, and they're going to chase them down. And so the dividend rates for the past 45 years have been higher than the federal funds rate, because the life insurance companies locked in good returns in bonds here. So even when the rates got lower, the companies had 30-year bonds that they bought at 19% in 1980, right? Or 20% even in 1980. And then finally in 2010, they had these bonds expiring, right? So this whole window here, they had this 19% bond, like propping up the dividend rates for the life insurance company, right? And so like that was a huge advantage. So there's no wonder, like this is why when I say index universal life became popularized in 2009, that's why, because these companies saw in 2010, by the way, 2009, right before when IUL first started getting market traction and market share, life insurance companies looked at this and they had to say, wow, okay, we're losing this in our portfolio. We're gonna have to roll that money over, and we're rolling 19% money over into like 5% money. And that is just like catastrophic to a general fund, right? Like, I mean, they were super stressed out. That is what came to the Section 7702 changes, because we had a decade. It's like a lost decade of interest rates for insurance companies here. And so 7702 reduced the guarantees to 2%, because what did that do? It took stress off the general accounts and the need for the companies to have the guarantees in the general accounts. They didn't have to have so much money backing up every dollar on reserves. Because remember, life insurance companies, especially when we utilize it for banking, life insurance companies don't implement fractional reserve banking. Sorry, had to get a drink there. All right, let me see what's going on. Does that answer your question? Well, maybe it doesn't answer your question fully. Let me elaborate even more. So when we talk about this, where's the question? Going back over here. All right, I get a little excited and a little all over the map with this stuff. So, so when we look at arbitrage, it's not about this. You're actually going to have negative arbitrage, right? So when we look at it, year 1 through, let's just call it 8, is going to be negative arbitrage. Can you get positive arbitrage? The answer is yes. If the policy is mature enough, let's just call it year 8 plus, and if we're in an environment like we have been for the past 40 years. Then you can get positive arbitrage. Is positive arbitrage an absolute principle in infinite banking? Is that what it's all about? The answer is no, because as you said, as I showed, even in a policy that's mature 8 years or more, if we're going into the environment that we're in right now, you're still not going to earn positive arbitrage, especially with non-direct recognition. Now, is that good or bad? It's not either. It's just what is. It's about you understanding what you're getting involved with. Remember, we're talking about long-term goals, right? So we got to think about long-term. And so if we're thinking about a 40-plus year period, we know that we're going to go through these cycles. And the market is going to flow, and it's going to ebb and flow, and there's going to be a lot of shifts and a lot of changes. And what worked 2 years ago isn't the same thing that's working right now as far as like bonds and CDs, the financial tools and products and things that we have at our disposal. It's all shifted, right? And so, but we know over the next 5 to 10 years, it's going to shift again. And then 10 years after that, it's going to shift again. And so the one thing that is true is that life insurance companies have been doing this for 180 years, right? So if we know life insurance companies have been doing this for 180 years and we can buy and we can keep our money there, it's going to protect our safe, liquid, accessible capital. It's going to beat inflation over the long term. We're not going to give up liquidity of that money. And sometimes it's going to be worse than bonds. Sometimes it's going to be better than bonds. But at the end of the day, everything always regresses to the mean. But the thing is, how do you get your dollars to perform more than one function? How can you leverage and put your money in a place that has a filter where your money is guaranteed, where every decision goes through it? It's a financial foundational asset. It's getting your dollars to perform more than one function in the sense that it's going to provide a death benefit. It creates generational wealth. It does all these different things. Plus you get the tax advantages and the different ways that you can utilize it in retirement, right? And so hopefully that answers the question a little bit more clearly. But here's the deal. Like I look at this, it's not about positive arbitrage. And unfortunately, let me get this over here. Unfortunately, so many infinite banking people right now are talking about how infinite banking is all about positive arbitrage. And that is the problem, is that the more whole life agents are out there talking about the power of positive arbitrage, the more IUL agents are grabbing onto that and holding on to that being the thing that infinite banking is. And then they're like ripping in saying infinite banking, IULs and like infinite banking on steroids because you can get more arbitrage in IUL when in fact you actually get more risk. I mean, AG 49B is getting updated and they're going to eliminate the ability to illustrate positive arbitrage in IULs this year. So that is that. Okay, so hopefully that answers your question, Jonathan, on that. It is not about positive arbitrage. Can you get positive arbitrage? Yes. Is it an absolute principle? No. It's about the timing of the policy, the maturity of the policy. It's about the economic environment we live in. And at the same time, it's not about positive arbitrage. If you want to have a more personalized conversation about what that looks like with one of my coaches, go down in the link in the description below, set up a free clarity call, and they will coach you through what it looks like in your life. And so hopefully that helps.